Hey, what's going on, everybody? Today we're going to talk about dividend growth investing and how to build a portfolio that pays you income throughout the remainder of your life. Income that continues to grow every single year. And I'm talking about passive income. Income when you have to do nothing but just sit back and allow it to grow. So, first and foremost, I want to thank you for tuning in. I'm going to ask that you like, comment, and subscribe. And let's get into it. So hopefully you can find this educational and that you can learn something that you can use for your own self going forward. In The Richest Man in Babylon, he said that I tell you, my students, a man's wealth is not in the coins he carries in his purse. It is in the income he buildeth, the golden stream that continually floweth into his purse and keepeth it always bulging. That is what every man desireth. That is what thou, each one of thee, desireth, an income that continueth to come, whether thou work or travel. Or in today's terms, a man's wealth is not in the money that he keeps in the bank. It is in the income that he buildeth. So the objective is to build up a stream of income that continues to flow to you, whether you work, whether you go to the beach, whether you go on vacation, no matter what you're doing, the income continues to flow to you. And I'm not talking about annuities where you go and you basically sign away your generational wealth so that they can put you on a fixed income. I'm talking about income that continues to grow every single year. And that leads me to dividend growth investing. So let's get into the topic of dividend growth investing and what it looks like. Okay, so first and foremost, what is a dividend? A dividend is the distribution of a company's earnings to its shareholders and is determined by the company's board of directors. Dividends are often distributed quarterly, some may be paid monthly, and they may be paid out as cash or in the form of reinvestment in additional stock. Okay, so we're going to use Lowe's as an example, and we're going to look at dividend growth investing from a standpoint of shares that I purchased in 2016, and you can see how the dividend grows over time. So currently Lowe's has a dividend yield of 2.09%, and it has increased its dividend for 58 years in a row. Over the last 5 years, it's grown its dividend by an average of 18.77%. And if you understand the rule of 72, you know that 72 divided by 18 is 4. So that means that the dividend is growing or doubling about every 4 years. So your passive income, your annual income will be doubling about every 4 years. So on July 7, 2016, I purchased 156 shares of Lowe's. The price at that particular time was $79.91 per share. The principal amount invested was $12,465.96. And back then, Charles Schwab was charging $8.95 per transaction. Now it's free. And so the total amount invested was $12,474.91. So my first dividend payment I received from Lowe's back in 2016 was somewhere around $54. But Lowe's increases its dividend every single year. So here is dating back to 2018. So these are the increases here. So these are the dates over here when the dividend was paid. So every 3 months, May, August, November, February. That's when Lowe's pays its dividend. In 2018, Lowe's increases dividend by 17.07%. Now, this is just from the original investment with no dollars added up until we got to February of 2022. So we will go through this. So that 17% increase increased the quarterly dividend payment from $66.12 up to $77.78. All dividends are reinvested to buy new shares. Now you're paid dividends per share. So if it's a great company, you reinvest in a dividend, you're buying new shares. As you buy new shares, then that will subsequently increase the next dividend payment. So it went from 77.78 to 78.15 to 78.53 to 78.92. And then August of 2019, Lowe's increased its dividend again by 14.58%. And that's what you want. You want to have companies that are growing their earnings, because over time, a company that grows its earnings at a pretty decent rate is going to grow their dividend at a pretty decent rate as well. So that increased my quarterly dividend payment from $78.92 to $90.84. And this is just passive income. This is not anything I have to do extra. I don't have to do anything. All I have to do is just sit back and wait every quarter for those dividends to be paid. And the dividends continue to increase. So you can see correspondingly, most of the time, because Lowe's is still a growing company, you have corresponding growth in stock price. So 105, then so sometimes it's going to be up, sometimes it's going to be down, but over time, it will continue to grow. So $91.34 paid on November 6, 2019. Then the next quarter was $91.78, then $92.19. So this is all coming from reinvesting the dividend to buy new shares. In 2020, normally Lowe's increases its dividend in August, but in 2020, during COVID year, it actually pushed back the dividend to increase until November. However, it still increased the dividend by 9.09%, which increased my quarterly payment from $92.64 up to $101.43. So you continue on up. In August of 2021, because Lowe's had a great year, it was one of those essential companies that stayed open during the pandemic. And because the earnings grew so much, they were able to increase the dividend by 33.33%. So that made a jump up from $102.14 in quarterly dividend payments up to $136.59 in 2021. So what you're looking at is almost a double, well, actually not almost, but a double in income in 3 years. So in 2018, it was $77 a quarter. 2021, $136 a quarter. So that's almost the income doubling in 3 years. And that's just from the company raising its dividend, reinvesting the dividend to buy new shares. And this is all passive income that continues to grow every single year. And this is just one of the companies that I own that grows its dividend like this. Now, February 2022, an additional 8.134 shares were purchased, and the price at that particular point in time was $235.79. And so the investment was $1,917.99. So that subsequently, because of buying the new shares, that subsequently increased the next dividend payment or payout in May of this year to $144.59. And then August, Lowe's increases dividend again by a 31.3%. So now the dividend payment per quarter is $190.53. So if you take it, let's say we'll just round up to $200. That is $800 a year in passive income that is continuing to come whether I do anything or not. So, and you look at companies, Lowe's has increased its dividend for 58 years in a row, and it has a low payout ratio. So there's absolutely no reason to believe that it cannot continue to increase its dividend going forward. And ultimately, when you own great businesses, especially those that have really good capital allocation policies about returning capital to shareholders, then you can have companies that grow their dividend. So your passive income continues to grow each and every year. So $800 per year. So let's look at what that will look like going forward. Let's say the dividend continued to grow at over the next 20 years at $800 or 18% per year, like it has the previous 5 years. Okay, so I'm here now on investor.gov. I click on financial tools. and the calculators here for the compound interest calculator. So let's say Lowe's. So compounding works not only just in capital appreciation, but it also works the same way with income. Let's say 20 years. No, 20 years. Let's say Lowe's grows its dividend at 18% a year. So it's not just compounding in terms of how much money you grow into, but the income can grow at the same rate. So if Lowe's pays me $800 a year now, and over the next 20 years, it compounded at 18% a year, then in 20 years, Lowe's will be paying me roughly around somewhere between $20,000 and $25,000 in income, just for being a shareholder, just by reinvesting the dividends or just by the income, the dividend growing. Now, if I continue to increase my share count by adding new money, buying new shares, then that can cause the income to grow faster. Of course, this is all assuming that management continues to increase the dividend and the earnings continue to grow and the company continues to grow. But if you look back at the compound annual growth rate of Lowe's, just going through the historical aspect of it, so the compound annual growth rate to 2021. So if you go back, let's say 10 years, it averaged about 18% compound annual growth rate from 2011 to 2021. You go back even further into the 2005, 2006, you're looking at 20% growth rate over a 20-year period. So there's a possibility that not only can Lowe's grow at that particular amount, but it can be able to grow at a much higher amount going forward. So one of the things that I look at too is just trying to see how things work from a back test portfolio look at it. I can look at it and just see how things have grown over time. So I'll go to back test portfolio here. Let me just a little bit larger. So we're going to go looking at Lowe's, L-O-W, 100% invested in the Lowe's. And we also going to display income. Just kind of looking at, Lowe's from a standpoint, if $10,000 were invested way back in the day, and just to analyze portfolio. So $10,000 invested in Lowe's back in 1986, today would be worth about $3.8 million. So the compound annual growth rate, which I think is the most important number when you're looking at your portfolio in terms of long term, is at what rate can you get your money to compound for a long period of time? So Lowe's is compounded at 17.64% over the course of this last 35 years, give or take. So this 35 years of just owning the company. And all you had to do was just own the company. You didn't have to jump in and out of stocks. You didn't have to sell it and hope that it goes down cheaper so you can buy it back. All you had to do was own it. Just own the company. And so you'll see that there are certain years that it was down. It was down 37% in 1987 and 15% in 1990, 25% here, 19% here in 2002, 26% in 2007, and so far this year down almost 25%. So you're going to have these times when it goes down, but you're going to have more years in positive returns than negative returns, especially with good companies. And if you look at the income, you look at the growth of the income over time, and it's just reinvesting the dividends. And as the dividends are reinvested to buy new shares, your income continues to grow. So you're looking at $54,000 a year in passive income from a $10,000 investment that was bought and held for that 35-year time period. And if a company is a good company and it continues to grow and the fundamentals are good, there's no reason to sell out of it. All you have to do is just own the company, own a piece of the business. Now, I do not recommend ever just putting your money all into one company. So you can have a group of different businesses that continue to grow your income. So you have income growing from one company, income growing from another company, and that can continue to build your wealth. So the objective for me is to get to the point where I have enough income from my investment where it covers all of my living expenses and I don't have to sell any assets. So that is the objective, and that is my definition of financial freedom. Financial freedom is when you have enough income coming in from your investment where it covers all of your living expenses. You don't have to sell off assets. You don't have to worry about what goes on in the stock market. Is the stock market up or if the stock market is down? If you don't have income, then you basically living off quote unquote retirement, hoping that the market it doesn't go down. It doesn't matter what the market does because the income is not dependent upon, it doesn't go up or down based upon what's happening in the market. It continues to grow because the company's earnings are growing and they're able to raise the dividend. And by you reinvesting, you're buying more shares. So that increases the amount of income that you receive every single year. So you go through this. Now, let me point something out. So you could have gone through a period where you're investing, and you can go through periods where the money goes down. For instance, by 2005, that $10,000 investment had grown up to about $504,000. But you went through a period here, 1, 2, 3, 4, 5, 6, 7 years when you reach $550,000 where the capital didn't grow at all. So the capital appreciation if you're just focusing on your investments on how much money is growing into every single year, you can have some companies that go through this period where the capital doesn't grow, and you might get frustrated, like, oh, I need to sell it because it's not growing for 1, 2, 3, 4, 5, 6, 7 years before the company actually began to grow again in capital appreciation. But even though the capital wasn't growing, the income continued to grow from 1,500 to 2,400 to 3,900 to 5,000, 54, 63. So you got a continued growth in income. And even with the stock prices being flat, when you are getting more income, you reinvest in those dividends, you are able to buy more shares, which increases your dividend at an even faster rate, along with the company increasing its dividend itself. So if you find good companies that grow their dividends, you can continue to buy more shares, continue to buy a group of different businesses so your money can continue to grow and you can have that passive income. So hopefully one day you should be able to live off the income. Or even if you can't live 100%, you can have, a great amount of your living expenses covered by the passive income based on you being a shareholder of these great companies. And that's one of the reasons why I buy businesses. I buy really good businesses with good fundamentals that grow their dividends with the objective, I should say, of one day being able to live off of these dividends. All right. So focus on buying good companies that have growing earnings, good fundamentals, good market share, and they have some competitive advantage. There's Lowe's and there's Home Depot. I own both, but today we're just talking about Lowe's and just giving you a sense of just how an investment, if it's left alone and you allow your money to compound, can benefit you over a longer period of time. All right, so invest in good companies and just leave your money alone. Let it grow. Buy, hold, and prosper.
I think it's usually a bad mistake to sell your interest in wonderful businesses. I don't think people find them that often, and I think they get hung up if they've sold them at X that they want to buy them back at 90% of X or 85% of X, so they'll never go back in at 105% of X. So I think on balance, if you are in a business that you understand and you think it's a really outstanding business, that the presumption should be that you just hold it and don't worry. And if it goes down 25% in price or 30% in price, if you have more money available, buy more. And if you don't, so what? Just look at the business and judge how it's doing.